Hey Bowtie Nation, Joseph Hogue here with kind of an emergency update video because I know a lot of you are going to have questions seeing things like this. Super microcomputer ticker SMCI down 16% after hours here. Today, advanced micro devices ticker AMD down 6%, going to open up very weak on that one. And then Arista Networks going to be up big today, 12%. So kind of a quick video here, just using the webcam instead of the 4K camera, maybe a little less produced, a little less bells and whistles here. Been thinking about doing these quick news related videos, updates lately. Let me know what you think in the comments. If you want to see more videos like this, quick off the cuff kind of news related updates to some of the stocks we watch on the channel, or if you like the more produced flashy videos better. So let me know about that in the comments. But back to that, looking at these charts in the after hours, it is nasty. 16% down super microcomputers, 6% down for advanced micro devices, AMD. Arista's kind of nice here, up 12%, but it doesn't cover the fact that we're going to see 16% down in super microcomputer when it opens up today. And this is exactly what I talked about Monday though. Stocks with good but not great earnings are getting slammed, and it's actually turning out to be a buying opportunity. We see here from the most recent FactSet earnings data, following earnings for the 500 companies in the S&P 500. And looking at price reactions to those earnings, we can see that companies that have had a positive surprise to their earnings, so companies that have beaten their earnings expectations, what analysts thought the companies would report, have only seen a 0.9% increase after that, after they beat those earnings. That's compared to a 1% increase average over the last 5 years. So not being rewarded very much at all. Only 0.9% for companies that can actually surprise the market on the upside with those earnings, come out with higher earnings, higher outlooks, things like that. Look at the other side though, negative 5.6%. Companies that do not surprise the market on their earnings, that maybe come in under expectations, are getting slammed. 5.6%, their stock prices are going down on average over the next couple of days and over that day. That is more than twice the 2.4% average or 2.4% drop in the stock price for those companies that miss on those expectations. And here we see another view of that. Average price change by percentage surprised. So what this shows is these blue bars are the numbers of companies that surprise at a different percentage. Okay, so this biggest blue bar here, 126 companies so far in the S&P 500 have surprised by about 0 to 5% higher than what analysts were expecting. Okay, this 112, this next blue bar here, those 5 to 20% upside surprise. So 112 companies in the S&P 500 have reported earnings that have beaten expectations, that have surprised on the upside by 5 or 20%. Very strong, very healthy upside surprise on those. On this other side though, we've got 31 companies that have missed their earnings expectations, missed those analyst forecasts by 0 to negative 5%. So they have missed by up to 5% on those. And then 5 to 20%, 20 to 40%, below 40%, only 6 companies there. But what we see here is just indicative of this market. It is a sign of an overextended market, a market just looking to take profits and looking to sell stocks. Because look at this, even stocks that have surprised on the upside, even stocks that have beaten their earnings expectations by 0 to 5%, up to 5% earnings surprise on the upside, have seen their stocks fall by 0.8%. Okay, so the market is not rewarding stocks that have surprised on the upside. Companies that have surprised by 5 to 20%. Imagine that. Surprising the market by 20% on your earnings, only getting a 1.7% bump in your stock price. Here on the other side, we see the opposite here, negative 3.9%, negative 3.6% for companies that have even slightly missed their earnings expectations. And again, folks, that to me is just a sign of an overextended market. Expectations just getting too high, a market that just wants an easy excuse to take profits. And it turns out that is a buying opportunity because we see this probably once a year, at least in one quarter out of each year. This is the the S&P 500 negative EPS surprises over the last 5 years. Okay, it's the average price change percentage. So what we can see here is kind of that chart that we showed earlier. Companies that are missing their earnings expectations, companies that are missing on the downside, missing their earnings expectations, and what happens to their stocks. We can see here this quarter, negative 5.6%. Companies that miss their earnings expectations or the forecast set by analysts, they're seeing their stock price fall 5.6%. And you can see over time here, it's about 2.4% is the 5-year average. But you can see about once every year, maybe a couple times here in 2023, it happened twice, but usually about once a year, the market just gets extended and it has to be reset. Okay. These expectations have to get reset. And we see that about once a year. Here in 2021, 3.7% stocks came down that missed their expectations. In 2022, stocks came down 5%. Here in 2022, again, 3.5% in the third quarter. Here in 2023, it happened twice, in the first quarter and in the third quarter. When stocks get when expectations for stocks get so high, then stocks just can't beat those expectations. So, it becomes harder and harder for stocks to beat those expectations. So when they can't do that, investors are disappointed. Investors are just looking for an excuse to take profits. So they sell these stocks off very hard. But then it becomes a buying opportunity, because once the market has those expectations reset, it's not expecting that much. And even a small surprise is going to boost those stocks in these next quarters. And a part of the problem here, folks, is that investors are just so super short-term focused. Here we see the average holding period on shares, New York Stock Exchange data. So what this shows is how long people were holding their stocks, all the way back to 1930, right? And we can see here, up until like the 60s, the 70s, people held stocks for 6 years at a time. There was much more of a buy and hold mentality. People put their money in stocks, forgot about it, and just let them go there. And look at this line though. Right now, 2025, and this is actually much lower, 2025, investors on average are holding their stocks for less than 5 months. Okay, it is very much a short-term sell to the next guy, take your profits kind of mentality. And so what happens because of that short-term focus, when investors just get so excited about stocks and the expectations get so high that they just can't be beat, then we have these periods of sell-off in the market or in just individual stocks themselves, like what we're seeing with Supermicrocomputer, like what we're seeing with AMD, which actually had a very good earnings report, but just wasn't good enough. This is a problem. This is actually part of a research project I'm doing to talk to investors and see how investors are investing and why they're investing that way. And actually, I'm offering a one-on-one analysis. For the first time ever, I'm offering one-on-one portfolio analysis to investors. Go to the link I'll leave in the description below. You put in your data, you show your stock trading data. With that, we're going to be able to tell whether you're selling too early, whether you're selling too late, even if your actual stocks and your stock trades match up with your goals, and give you some ideas on some real actionable insights into how your portfolio is looking, where it needs to be. It's all part of that research project I'm using to really understand investor behaviors better, why we have this super short-term focus, and to help investors invest better. But folks, if you can lock in on some of these bigger picture ideas like we talk about here on the channel, some of them like we're going to talk about today, like this $365 billion being pushed towards AI spending, this AI arms race that's going to a lot of these companies like we're talking about, Supermicrocomputer with its servers, AMD with its chips. Look past these short-term dips. I like to say investing in these overextended markets is kind of like climbing a mountain, right? And I know all about climbing mountains in the Marine Corps, right? Camp Pendleton with some of its mountains, the ankle breaker, mountain motherfucker. I hated those mountains. I hated them with a passion, because a mountain, it doesn't go just straight up. That would almost be better, right? If it went straight up, you get to the peak quick and you get to your descent. No, most mountains, you start going up and you go up for a while, and then they kind of level off, or they kind of come down into a valley, and then they head higher again, and it's like that over and over again, where you're heading up and then you kind of level off, or you go down into another valley and you go up. That's a lot like stock prices, and a lot like these big picture trends, right? These big picture ideas, that's the mountain. The stock price is the path upwards. And what you get with a lot of these, people expect them to go just straight up, $365 billion heading into servers for Supermicrocomputer or chips for AMD, and people expect them to go straight up. And when they don't, they get nervous. When they hit those little level off points, or when they hit a little down point like Supermicrocomputer is going to have today, they get nervous and they sell out. But if you look at these big pictures, you look out ahead of you, and that mountain is going straight up. Okay, that mountain, that big picture trend, that is going up. That trend is going up over time. So you just got to stay on the mountain, keep on heading higher, even in these little valleys and these little low points. But let's get right into those. Hey, we're going to start with super microcomputer because I know a lot of you are going to be here for that. It's down 16% after hours. It's going to be down as much as that in the regular trade. Now let's look at the news, see what those results were and why they were so bad, and why I actually think I'm going to buy more shares on this. Here we are in earnings here, and we can see that super microcomputer, it did have full year revenue. So their fiscal full year ended over the last quarter. So they reported $22 billion. That was below the $22.3 billion analyst estimate. So they did report revenue that was under analyst estimates. They did miss on revenue. They also missed on earnings, I believe, right? They projected fourth quarter. Here we'll go down here. It was profit of $195 million. That's compared to $297 million a share a year earlier. That was also, it's 31 cents per share. It was also under the analyst estimate. So stripping out one-time items, the earnings were 41 cents. That was behind the 45 cents forecasted by analysts. So not only did they miss on what Wall Street thought they were going to report as far as revenue, they also missed on earnings as well. And a lot of this is coming down to really the competition in those server space, okay? And that takes us to that major theme that we've been following with super microcomputer, SMI, and a lot of these other chips, AMD, NVIDIA's in that theme. It's this $365 billion that just the big hyperscalers, okay, just 4 companies here. Understand this is just Amazon, Meta, Microsoft, and Alphabet spending $365 billion on that AI arms race, okay? They're going to be spending on data centers, everything that goes into data centers, like chips, like servers, like networking infrastructure we're going to talk about later with Arista Networks. They're spending $300, and that money is not slowing down. You see here, this chart, it's up from $222 billion just last year, and it's already being upgraded. $325 billion at the start of this year is what we thought they would spend. Now they're going to spend $365 billion. So this spending is not slowing down. It's really driving these stocks up higher. That theme taking these stocks way higher. You can see before that big 17% drop that we're seeing in the after hours, this stock was up 87% year to date. So yeah, anytime you have $365 billion plus heading into a theme, heading into these servers, these chips, into this theme, you're going to have competition, and that is eroding some of the pricing power and some of the margins, the profitability that we saw in these stocks. But that doesn't mean that the theme is dead, right? We got that $365 billion plus, and we're following it through the AI supply chain. Okay, we already know that NVIDIA was a big winner of that with its custom chips, with its AI powered chips, but we also have in those chips, we have AMD, we have, well, Intel really isn't a factor here, but they're trying anyway. We also have in the chips, in the accelerators, we have Broadcom, we have Marvell, other great companies with a competitive advantage in those chips, but those chips have to go somewhere, right? The chips are held in a server, within a data center. So within that, after that, we go to the server manufacturers. We look at Lenovo, we look at Dell, Hewlett Packard Enterprise, or my favorite super microcomputer here. A lot of these going to be getting a lot of that $365 billion money. And then we look even further into the infrastructure, like the networking analysis I'm going to show you later on with Arista Networks. It's not just the data centers, it's what's going into them. And really the whole plumbing, the whole networking infrastructure within these data centers is going to need a major upgrade. That's going to mean a lot of that $365 billion going towards the networking companies like Broadcom, like Arista Networks, like Astera Labs. So then again, if we think about that big trend as the mountain, even if it levels off sometimes like we see here with the 17% after hours drop with super microcomputer, even if it comes down a little bit, that mountain is still going higher over the longer term, over the big time, over the big picture. So if we look at that, we go to the analysis tab here on super microcomputer, and we can put this into perspective, really, this one-time drop, the 17% drop that we're seeing. We can see here revenue estimates for super microcomputer. So of the 15 analysts covering the stock, where they think revenue is going to be over the next year. And here it's updated. So the current year, this is the next fiscal year. And just like SMCI predict or forecast for its own revenues, they forecast around $30 billion. And that's what analysts have penciled in here, about $30 billion. That is going to be a 35% increase year over year. Okay. So, you put this into perspective. Yeah, they missed revenue forecasts a little bit over the last year by a few percent, really. It came in at about $20 billion instead of $23 billion. Okay. So even if they do that same thing here, even if they miss these, these are analyst estimates for 30 billion. Say they miss that by 3%. That's still going to be $29 billion in revenue. That's still going to be a 20 divided by 22. That's still going to be a 32% increase in revenue over the year. So that is amazing growth. It's really indicative of this $365 billion AI arms race. And I think once we look into the statistics here, or into the valuation, you're going to see what such a great deal this is. And folks, taking that big picture idea, that $365 billion in the AI arms race, and taking it back to the supply chain, I'm not just picking Supermicro out of the hat. Okay, with server manufacturers, we could have gone with Lenovo, we could have gone with Dell, Hewlett Packard Enterprise. I believe those are good stocks too. I think Dell is going to get an upside surprise when it reports on later on this month, August 28th, I believe, when it reports that its device and laptop sales are actually recovering. I think it's going to be a good stock to own too. But I'm picking Supermicro here because it has those best-in-class servers for AI. I think a lot of this $365 billion go into AI, go into data centers, and then go into servers. A lot of that is going to go to Supermicro. They have a controlling lead, about 20-25% on the AI-focused servers, because they've got those direct liquid-cooled servers. They've got a working relationship with NVIDIA, with AMD, with a lot of the chip makers to be able to design custom solutions, custom servers for those chips. It has a definable competitive advantage that makes it the best-in-class server maker within these companies. So here, if we go to the statistics tab on Yahoo Finance, we can see these valuation metrics, and this 16% drop, 17% drop, take it about to a $29 billion market cap. So what I'm looking at here, it closed at about $34 billion market cap. That's the total value of all the shares in the market capitalization. If we take off 16% of that, 17% of that, so 34.17 times 0.83825, it'd be about a $28 billion market cap. Now, if we take that divided by the $30 billion in sales over the next year. So the company, I think, forecasted about $33 billion. The market still thinks it's going to underperform that a little bit for those $30 billion in sales. But even on $30 billion in sales, that $28 billion market cap divided by 30, that would be 0.94. Okay, 0.94 price to sales. So market cap divided by the sales revenue, that is a price to sales ratio. So price to sales 0.94. Look, over this entire period, it did not get down that far. In fact, I think the low point when we were investing last year, at the low point right around $20 a share, it was down to about 0.75, 0.77 price to sales, and turned out to be a great deal, right? With shares up at $57 now, even with the drop down up at $47 from that $18 and $20 price where it was. That was a great deal, and I think it's going to be a great deal now at 0.94. Even if it gets back over to, let's say it only gets back up to 1.23 price to sales here over the next year. 1.23 price to sales ratio valuation, that's divided by 0.94, where it's going to be after this big 17% drop. That is a 30% upside potential return right there, just on that back to the 1.2 times price to sales. So folks, you cannot get scared out of these big picture stocks like this. We're going to cover AMD. I'm going to also show you Arista Networks, also show you some other news that I'm watching that could mean a huge cash flow upside for a lot of these other stocks that we're following here on the channel. But the point here is, the big picture is, you cannot get scared out of these stocks. You got to follow that mountain mentality. Okay, they might have parts where they level off. They might have parts where they come down into a little valley, but you cannot get scared out of them, because they are up over the long term, and you got to take these dip opportunities when you can. You can see here my buying in Supermicro. I was buying all the way into, actually into August, September, and November of last year. November of last year, when it hit $18 a share, I was buying heavy, and I'm up 223% on that. For my total shares here, just under 18,000 shares here, worth about $1 million. Obviously, that's going to take a big hit tomorrow, or when the market opens today, but it's still going to be up. Okay, my average price $33 per share. Right now about $47 in after hours. it's going to take a big hit, but I'm going to be buying more. I'm going to be taking advantage of this dip, and I'm going to see it back up to at least, $80, $90 a share. Let's also look at Advanced Micro Devices, ticker AMD, because you're going to see that was also one of my big holdings, actually my second largest position, down 6% after hours. But even after that, still up 44% for the year. And here in my portfolio, you can see it is my second largest position, up 64% since I started buying, really screaming to buy this thing over the last year at those bargain basement prices. I was adding it all the way up to $110, $115. My average price right at around $108. Up 64%. It's going to obviously take a hit on the 6% drop, but this company actually had a very good earnings report. Looking at these earnings, folks, this is exactly what I'm talking about. Just an overextended market. Expectations got crazy high. AMD actually had a very good earnings report, and it's down 6% after market's going to be down today. But if we look through here, you can see what a great earnings report this was and why I'm still buying this stock. If we scroll down here, we can see posted a profit of $872 million. That's about 54 cents a share compared to $265 million last year. Same quarter last year, 16 cents a share. If we do that, what is that? 54 cents divided by 16. That is 237%. Okay, they grew their earnings, their profit by 237%. Adjusted for earnings were adjusted per share 48 cents. Revenue rose 32%. This is a company that saw 32% sales growth to $7.7 billion. That was above expectations. Analysts thought the company would post about $7.4 billion. They beat that, $7.69 billion. Data center revenue, what we're really talking about here with this AI arms race and the chips that AMD makes. Data center revenue rose 14%. Client gaming sales rose 69%. Okay, so these are some huge growth rates here, folks. The Lisa Su said, talking about the 350 series of accelerators, really giving NVIDIA a run for its money on that AI segment. Here's what I'm looking at here. The current quarter, company guided revenue of $8.7 billion, right down here, plus or minus $300 million. It's up from $6.82 billion. So a year ago, it posted $6.82 billion. If it hits this $8.7 billion target, that would be $6.82. That would be growth of 27% over the year. Analysts were expecting $8.32 billion for this coming quarter, for the quarter that they're in right now. So not only did AMD beat the analyst forecast for earnings and sales, it upgraded its outlook above analyst expectations. And yet we see the stock down 6% in the aftermarket hours. We see a Wall Street and investors that just aren't satisfied with anything. And for the chip makers like AMD here within the supply chain, with server manufacturers, you've got a lot of other companies making servers, Lenovo, Dell, HPE. I think I saw even Foxconn is trying to retool their Lordstown, Ohio plant. Was supposed to be making electric vehicles. Now they want to retool that to make servers. So Foxconn getting in the game. Here with chips, you've got a much more limited competition, or good competition anyway. We're not going to add Intel to this list because I don't think they're anywhere even close. But you've got NVIDIA here, obviously dominating that AI chips theme, but AMD giving it a run for its money. You've also got Broadcom and Marvell. They're in the chips theme with their accelerators, but it is much more limited as far as a competition there. So we're not seeing the pressure on the profitability, on those earnings, like what we saw with servers and Supermicro computer. That means a lot of that $365 billion, there's a lot of that to go around to these chip makers, and a lot of it's going to go to AMD. With all that in mind, we can go back to the big picture here, go to the analysis for Advanced Micro Devices, AMD. We can look at revenue estimates right now. 47 analysts covering this stock, coming to an average $32 billion in forecasted average revenue over this year. That's a 24% pace of growth, expected to hit 20% next year to $38 billion. But we're going to go with this $32 billion number. We're going to use that to build into our valuation and see, why, even though they're probably going to beat this, just like they beat expectations for last quarter and over the last year, they're probably going to beat this $32 billion. But we're going to use this as a conservative estimate to build into our valuations. So show you what such a great deal this stock is going to be here at 6% down in the after hours. So here we are on the statistics tab in Yahoo Finance, going to give us our valuation metrics here, and that $282 billion market cap. So that the total value of all the shares in the market, $282 billion. That is probably going to drop to about about $268 billion on that 6% drop in the market today. So on that $32 billion in sales. So if we take this, here we go, this 282 billion times 0.94, it's going to be about $265 billion market cap, total value of the shares after this big 6-7% drop that we're going to see today. 265 billion divided by that $32 billion in sales, going to drop it back down to about 8.3 times on a price to sales valuation. Okay, back to 8.3 times. That would put this stock back into value territory. Okay, we started buying it right around this 6.5, 7 times price to sales. Here it was over the last year. It got up, when it went to 175%, when it went up that 44% this year, it built up to 10.2 times on a price to sales basis. Now that is not a lot. That is not expensive compared to other chip makers, especially compared to NVIDIA, which I think trades for about 20 to 25 times price to sales. But even this 10.3 times is going to drop down to about 8.3 times price to sales. That is a steal, folks, even if it only comes back to this 10.2 times. So 10.2 divided by 8.2, you still got a 23% return potential just back to this 10.2 times price to sales valuation. Looking at shares of Arista Networks, though, ticker ANET, you're going to have a very good day, though, up 12% here after hours. Looks like the money is finally flowing into that networking theme I've been talking about. That's because, well, the chips and the servers have gotten all the attention, right? The chips from NVIDIA, from AMD, the servers from SMCI. The bigger bottleneck in that AI arms race theme, where a lot of that $365 billion is going to have to go, is in that networking hardware and software within these data centers. Okay, so within these data centers, you've got the storage of the of the stuff that's of the data that's got to be put through the network, put through the pipes, right? The infrastructure. Think of networking hardware and software as how that data gets back and forth from users back to servers and so forth and processed. Okay, that networking infrastructure in data centers is horribly outdated. The amount of traffic that's going to start going through these to generate through AI, through agents, through that machine-to-machine environment, like we see here, this quote by Chris Sharp, Chief Technology Officer over at Digital Realty. That amount of traffic is immense, okay? And the networking infrastructure is just not ready for it. So it's going to need a big chunk of that $365 billion to upgrade that networking hardware. And that's where leaders like Arista Networks, like Broadcom and Astera Labs comes in. In fact, I've been talking about these networking infrastructure stocks since February of this year because I think it's a part of that AI arms race that isn't yet caught on in the market yet. We've already seen those chip makers like AMD, obviously like NVIDIA, that have boomed higher on that AI arms race theme, on that spending. We've already seen the servers, the SMCI, as well as some of the other server makers boom higher. We hadn't seen it yet in these infrastructure names until now. This 12% rally in Arista Networks on its earnings. I think this is just the start of where these can go. In fact, in this February video that I did on these 5 infrastructure stocks that you needed to be getting into, these 5 stocks are up an average 35%, up an average 35% over that time. The market is only up 2.5%. So beating the market by 33% in these AI infrastructure stocks. Again, I think there's much more to go on these, but so you need to focus on the real leaders in the space. This Arista Networks that we talk about, the Broadcom and the Astera Labs, real competitive advantages in AI infrastructure. I also want to highlight one story here I saw in Wall Street Journal, something I'm preparing a full video for, but I wanted to give you a heads up here because this could be a very big story and the market clearly isn't pricing it in yet, okay, because of some changes to tax laws, depreciation and expensing in that big beautiful bill, right, that was just passed, the government's budget, because of some changes to that in how companies depreciate their assets, how they expense some of their costs, could be a cash bonanza for some companies. We can go through this article here to see just kind of the effect of it. It highlights AT&T here, said it expects $1.5 to $2 billion in cash tax savings this year alone. Okay, it's going to grow from there. The high end of that range is 11% boost to analyst estimates of 2025 free cash flow. Okay, so 11% boost to free cash flow for AT&T just from that bill. I don't believe that's priced into the stock just yet. But if we look at this, look a little bit further, It gets even better here. AT&T is nothing compared to some of these others. Okay, Zion in a recent report estimated that Meta Platforms, so META, going to cash savings of $11 billion this year. Okay, that is above and beyond what analysts thought that they would report. $11 billion in free cash flow, higher just because of these changes, these tax law changes. That is equivalent to 30%, okay? Equivalent to 30% previously estimated free cash flow. So imagine that. You got a stock that is all of a sudden going to see its free cash flow boosted by 30%. And I know a lot of this accounting jargon might get lost on you, but if we go here to the cash flow statement, okay, and folks, as an analyst, this is where you spend most of your time, okay? Everybody wants to focus on earnings and revenue and all that. Cash flow is where it's at. One, because it's a lot less easy to manipulate than the income statement, okay? Companies have all kinds of tricks and shenanigans they can pull with that income statement to make even their revenue look higher than it actually was, but especially all the way down to their earnings. So everybody looks at earnings, price to earnings, valuations. Everybody looks at earnings per share growth. Well, companies are manipulating that like no other. Okay, they have all kinds of tricks. They can make their earnings look higher. You go over to the cash flow statement, and this is actual cash generated by the company, cash in and out of the company. So this is a much truer picture of the operational value of the company and really what's left over for investors. That's what we're talking about here with this free cash flow. If you look here within the cash flow statement, you've got the operating cash flow. So what the company is generating for just its operations, investing, which is what it pays out or comes in if it sells investments. Usually this is a negative. Usually this is the company investing in R&D, so research and development. This is the company buying other companies, buying other assets. That's investments, and that's cash outflow. I'm not going to bore you with a lot of this stuff, but basically what happens here, this free cash flow, that is usually the operating cash flow minus some of this investing cash flow, okay? So the operating cash flow, what the company booked in its operations as far as cash actually coming into the company, not just booked revenue and booked earnings and all that accounting shenanigans that they have over there on the income statement. That is actual operational cash flow coming into the company, then minus some of the investing cash flow they need to invest to keep the lights on there at the company and keep growing. With that, you get the free cash flow. And theoretically, this is the cash flow that is left over for investors. Okay, this is your truest measure of what that company is generating for investors every year. Here for Meta, we see free cash flow over the last 12 months was $50 billion. Okay. So to put that into perspective, $50 billion it generated for investors over the last year. If it boost that by $11 billion divided by 50. Again, that is 22%. That is a 22% increase in the cash generated for investors over the last year. What do you think that's going to do to the shares? Well, if we go here and look at the shares, just since the big beautiful bill was passed, it hasn't really done anything. I mean, this was on earnings. The earnings were very good for Meta. It did increase about 7%, but this says nothing about that 22% and more cash flow that the company is going to have. So I think this cash windfall that they're talking about here is not built into these stocks. This is something you need to be looking at. You need to be investing for this, because if you look at some of these big, beautiful windfalls is what it calls it. You look at some of these, Alphabet is going to have $18 billion more cash generated per year. So if we go over here to good old Google, and if we go here to the cash flow statement here in the financials tab, go to cash flow, and we see that Google, or Alphabet, I still call it Google, free cash flow of $66 billion over the last 12 months. Okay, $66 billion free cash flow. They're estimating it's going to increase that by $18 billion. Okay, so 18 divided by 66. Google or Alphabet is going to get a 27% bump in its free cash flow, all from these tax law changes. Okay. So, that might seem like, tax law changes, oh, it really doesn't affect the company. It does. Okay. 30% more valuable because of that cash flow there. Amazon's going to get about $15.6 billion. Microsoft, $12 billion. What I want to look at here, Amazon, $15 billion more cash flow than what it reported. AMZN, we can go here and we know what happened to Amazon over the last week, okay, from its earnings. It's down 7.5%. So obviously, and if we look at year to date, it's down 2.5%. Obviously, the market not pricing in that additional almost $16 billion in cash flow the company is going to be generating every year because of these tax law changes. This is not priced into the stock here, folks. Okay, if we go to financials again here, we can look in cash flow. Cash flow of $13 billion over the last year generated by Amazon, $13 billion. They are going to double it, okay? $15.6 billion estimated tax savings. So an additional $15 billion cash for Amazon. That's going to double its free cash flow. That means a lot for this stock, and it is not priced into the market. Folks, it is the big picture news like this that you have to be on the lookout for, because it is your best shot at really seeing where the market is going with those trends, with those big picture trends like we talked about, that $365 billion and where it's going, working up that mountain instead of getting scared when it hits those little dips and valleys. And this other news, like this cash flow treatment in the big beautiful bill, where the market is going to be going, and then getting there first. Get your free one-on-one portfolio analysis with me by using the link in the description. And don't miss that options course relaunch. Save $150 off with the link below. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.